Hey everybody, welcome to the Chapter 5 quick review. This is the merchandising operations and the multi-step income statement. So there's your learning objectives. Mostly they just want you to recognize the difference between a service company and a merchandiser. And then we're going to talk about how we record purchases and sales revenues. And what it doesn't say here, but what I think is actually a major part of this chapter, is understanding the discount terms and how to record sales discounts and those sorts of things. And then we have distinguishing between a single step and a multi-step income statement, which is pretty easy, and how to figure out cost of goods sold. And so that should be about it. Let's take a look at it. So first of all, just recognizing that a merchandiser sells stuff as opposed to selling a service. And when you sell stuff, that creates an extra line on your income statement for your cost of goods sold. And then the income statement will show the sales revenue minus the cost of goods sold will be the gross profit, minus the operating expenses will give them the net income. So that, as long as you understand the blue terms through here, you're in pretty good shape. That's all just informational stuff. So here's where it gets a little tougher, where we record the purchases of inventory. So when a company purchases inventory, they show their inventory account going up and their accounts payable, if they didn't pay in cash, also going up. So that's the general journal entry. This whole discussion of freight costs and who owns the goods when, and who pays for them. So there's FOB shipping point. FOB means freight on board, and then there's FOB destination. So if you purchase something FOB shipping point, that means that the owner, the person buying it, takes ownership of it at the point where it's shipped from. So that means that the buyer pays for the freight. And if you buy something FOB destination, that means the ownership doesn't change hands until it gets to the buyer's location, which means the seller pays the freight. Any freight costs are usually included in the inventory. So there's the journal entry: inventory increases, cash decreases to pay for the freight. If you're a seller, they usually record that as an expense. They call it freight out here. I've seen it as freight expense, those sorts of things. And then there's purchase returns and allowances. Again, read the blue terms, make sure you understand what they are, and make sure you can do a journal entry that shows, in this case, they have a return. So the company returned the goods, so they reduced their inventory by 300 and reduced their accounts payable. I think that's pretty doable. You just need to make sure you understand what it means. A purchase discount is a little bit different. Remember the nomenclature here, where they have things listed as 210, or here's N30, which means the net amount is due within 30 days, net 60, net 10, here's 210, net 30, which means a 2% discount if paid within 10 days. Just make sure you understand how those discount abbreviations, what they mean, and then make sure you can do a journal entry that involves them. I would expect a question that kind of tells you that a company purchased merchandise for a certain amount, and then that they returned some of it, and then that there were terms of a certain amount, and then how much would they have to pay, right, if they paid within the discount period, or what would the journal entry look like, or what would the debit or the credit of the journal entry be. You saw those on your previous exams, and so I bet you on the final you're going to see something similar. So be prepared for something like that. Make sure you understand how discounts work, and make sure you can work journal entries that involve them. From the other side, if you're the seller of the goods, then it's the same idea. Remember that when you sell goods in a periodic system, in a perpetual system, you've got to do 4 entries for every sale. You have to show your accounts receivable, that's money owed to you by the person buying it, increasing, and your sales revenue increasing. That's at your retail price, the amount you're selling the stuff for, and then your cost of goods sold, that's an expense, increasing, and your inventory decreasing. that's at your cost. So there's always a revenue and an expense. The revenue is at your sales price, the expense is at your cost, and then the change to the inventory. So make sure you're very comfortable with this concept of how the transaction works when a merchandiser sells something. Sales, returns, and allowances. So again, these are the returns and allowances from the seller's standpoint. You'll see that, sales, returns, and allowances, a special account. They'll debit that, and accounts receivable will be credited. But again, you see how that's a two-part or a four-part transaction there with 4 entries. So we have to do this at the retail price and this at the cost. Sales discounts work similarly. Usually we record them when you get paid. So when they accept it, then your cash goes up by the amount they paid you. Your accounts receivable goes down by the full amount, and the difference is always your discount that you allowed them to have. So make sure you fully understand how all those discounts and everything else work. So the income statement, there's the income statement you're used to, but in this case we would use a multi-step income statement. Let's see, it should show us one here. There it is, sales minus the sales discounts or the sales returns would give us net sales. Then the cost of goods sold minus that would give us gross profit, and the operating expenses, and so forth. So make sure you understand what this multi-step income statement looks like. The biggie is that it has the sales revenue and sales discounts, whereas the single-step income statement doesn't have all that. And then the last thing you need to know for this chapter is how to calculate gross profit rate, which is your gross profit divided by your net sales, and how to calculate profit margin, which is the net income divided by the net sales. And that'll really do it for chapter 5. Like I said, most of all, I think the big takeaway, even though it wasn't, this is something I don't like about this chapter, even though it wasn't listed in this overall list, the thing that they're going to be most likely testing you on is making sure that you know how to journalize those sales transactions and the sales terms and the sales discounts and all those things. And I guess that's what they mean by explain the recording of purchases, explain the recording of sales. But that takes a lot into account. And the most important thing is that you know what the sales discounts and returns and all of those things mean and what they look like when they get put into a journal entry. So if you understand that and you understand the terms, you're going to do pretty good on this chapter.